Could they raise rates? Yes. Should they raise rates? No. I mean, it's a two-horse race, so I guess there's a 50-50 chance. I think, yes, they put December back more in play, and that's what the market was reading into the last statement. But at the end of the day, I mean, if we were trading at, say, 3% interest rates right now, would anybody be arguing with the economic data that we've just seen? Would anybody arguing for them to hike rates? I don't think so. So, I mean, I don't want to say perplexed. I understand where we're at when it comes to the rates in the market, but I totally disagree with raising interest rates unless we have an economy that's overheating or an economy that's about to overheat, and I don't think we're anywhere near both of those.
So if we don't see a rate rise, I mean, there have been some suggestions now floating around that we could see more quantitative easing or more stimulus, given that we've seen, obviously, a number of those other central banks, the likes of the PBOC across in Europe as well, with further easing. What do you think are the chances that we could see further easing in the US?
Well, I mean, negative rates are something that are being talked about now for sure. I mean, we've started to see them in Europe. We've started to see the Euribor in Europe trading in a negative rate space. The whole idea that the global situation has cooled, I don't really understand, because I think that the 6.9% GDP was not true from China, and the reason why I think it was not true is because just after that they cut rates. I think they cut rates because their economy is cooling, and that should be something that the Fed should be worried about. The Fed's really not only looking at asset prices or equity prices, and that's why they think that everything's cooled. But if you really take a look under the bonnet, things don't look that good. I mean, again, we don't really have any wage pressure here. We've had 6.5 years of 0% emergency level interest rates, and we can't really buy any inflation with that. Where is this economic engine really doing very well that you'd say that we should raise rates? I think the Fed should take a step back and take a look at everything. Go ahead.
Scott, isn't it doing quite well in the consumer? We are seeing the consumer coming back. I know the headwinds from the global will pull down the economic growth in the US, but the consumer has definitely come back, and you are seeing a pickup in capital investment in the US. And also you can see the tech companies from their capital investment are doing quite well.
Well, the housing market is still on its knees. The 5.1% unemployment number with an all-time record low participation rate is discounted. I think that consumers come back a little bit, yeah, but at the end of the day, at $4.5 trillion to expand our balance sheet to get you a continually revised lower GDP of, say, 1.7 this quarter, I don't think that's really great. So I think that, yes, I want things to get better faster, too. We're going to be busier down here, and things will be a lot better for everybody else. However, if you just look at the real raw numbers or stay as data dependent as the Fed does, that's not going to give them the room, I think, that they would run and raise rates. I mean, would you really, let's just say, George, if we had 3% rates here in the States today, given the economic data you see in the U.S. and around the world, would you be arguing for a rate hike?
No, but I wouldn't be arguing for a rate hike. But also, if you had zero rates today at those levels, I'd be arguing for a rate hike, because the monetary policy is still very loose in the US, you know, and we're just talking about a quarter of a basis point. And I'm actually beginning to worry that the low interest rates in the US are creating these liquidity traps, while, you know, if people had the expectation of raising interest rates, you'd actually see the consumer coming back stronger. And I think now that these low interest rates are creating these, you know, classic liquidity traps, which are keeping consumers and business investment out of the market.
That's absolutely a risk. But there's also another risk that we raise rates, we hurt corporate earnings abroad even more than they have done with a stronger dollar. We get the commodity market rolling downhill again. We get oil crushed again. I mean, there's a lot of things that could happen with just a 0.25% interest rise. And I agree with you, it's just a quarter. But if it's just a quarter, why do it? I mean, I can argue the other side of that coin. So I understand that low rates or zero rates are a bad thing. But I also understand that raising rates to stay relevant, but not because of the economic data that's coming across your desk, is also a bad thing. That's why I think the Fed does nothing, because they're stuck. You could argue we should be cutting rates with a lot of the economic data that's come through. And some people like you, and I understand, you want to get off that 0% thing because of liquidity traps. So that's why I think the Fed does nothing, because they can't.
Scott, Janet Yellen obviously really has, you know, a pretty difficult task, I guess, of signalling the Fed's intentions without causing too much market confusion. That certainly happened, though, in September. Do you think that's likely to happen this time around? I mean, do you think it's the Fed's fault for a lot of this confusion, or do you think it can also be put down to the economy not really cooperating and performing to the extent that the Fed originally thought?
Well, I mean, if they were that worried about 0% interest rates today, they should have been, you know, worried about it a year ago or a year and a half ago, when we had expectations of a 2.9 to 3% GDP. Well, that's been all but washed away, but that was their opportunity to raise rates. You could have made a much bigger case for it 18 months ago than you can today. And since then, they've stayed data dependent. The data has continually gotten worse. And as the data has gotten worse, it's made them harder for them to raise rates. And that's the cycle that we've been in as of late. At some point in time, I think what they did today is they definitely put December back on the table. And hey, if they raise rates to stay relevant, not because of an economic climate or conditions that say they should, that's going to cause roils in the market, and I'm glad about that because then we'll get busier in the brokerage space, but I don't think it's the right thing to do for the economy.
And Scott, when you talk to the market down there, which is kind of going back to Leanne's question, are you finding that the the Fed has lost a lot of credibility on the floor down there?
Absolutely. Hey, absolutely. Number one is the answer to that. But number two, let's go back and look what the Fed was saying 3 or 4 years ago. They were saying we should be at 3% today. I mean, why do we continually look at everything they say and do when they're always wrong? I mean, they've been consistent, but consistently wrong. So let's just say if they raise rates in December, it will be wrong. I think that they should wait and see if we can get an economy here or some sort of true growth, not central bank inspired growth, and then I would start to think about it. But I think they're stuck. I don't like low interest rates either. I think zero is bad. I agree with you. But I also don't think that we're in an environment to hike them. So I think the Fed is in a corner.
And watching the Fed is just boring, getting boring now anyway. And it's much more interesting to talk about oil, which is probably the biggest story today than what happened in the Fed.
Yeah, I know, and we had a good short cover rally in oil today, but I tell you what, George, I think that oil could lead the way. If you see the bottom fall out of this oil market, which would go against what everybody really wants to think, that could send stocks lower. And then here we've got the Fed worried about the interest rates again, and that could be a problem. So I think you should keep your eye on oil. I think you're right.
I wanted to ask you, and you alluded to it earlier, Scott, but, becoming more and more difficult, I guess, for the Fed to raise those rates, given the fact that they haven't already done so, especially after we're seeing more quantitative easing and stimulus from other central banks. Do you think the Fed is losing control? One of our other guests this morning was suggesting that Mario Draghi, is actually running the Fed.
That might be the case, and if Draghi's running the Fed, I mean, I think he's in a pretty dovish mode right now. I mean, the Euribor contract, like I said, in Europe is already trading at negative interest rates now. To think that the Fed wants to raise rates here to make us even more stronger as far as the dollar goes, but less competitive abroad, that's going to be a bad thing. I mean, our earnings are going to suffer. So to think that the U.S. can just sit here and go it alone, I think is kind of naive. And I think, yes, I think the Fed has made some mistakes, some big ones up for the last 2 years. And yeah, it could be said that maybe Draghi's running the show over here. But at the end of the day, the world's weak. We're kind of weak, and is that the real reason why we think we should get out of bed and raise rates? I don't know.
So going back to that story, Scott, what do you guys think is going to happen with the Bank of Japan when they meet later this month, or this week, I think? Do you think they're going to see more easing from them?
I think that. I think we might not see more, but we're not going to see less. I mean, I think that they're going to continue down their path. They're already, what, 25 years into the path that we're looking to go down ourselves here. And I think there's an argument to raise rates in the States so we don't become Japan. There's a lot of similarities there. There's a lot of differences, but there's a lot of people behind me that get scared that we might be seeing a Japanese kind of a cycle here in the States. So at the end of the day, George, it's all about true growth. And you know what I'm talking about. We've only seen the stock market rise on free money. We haven't seen the stock market rise because anybody's killing it out there. And I think that's just the real big worry. Where is that growth going to come from, and when is it going to happen? And until that happens, we're going to be debating quantitative easing, negative rates, and what the Fed, PBOC does, Bank of Japan, blah, 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 until the cows come home when we do finally see the growth.